For Wall Street Media, I'm Mike. I'm here with Doug, and we'll help you make money in the stock market with information you can't find anywhere else.
Hey, good morning, Jeremy.
Good morning.
We're a little late on the good mornings, aren't we?
That's true.
We started at 1 o'clock this morning, kids, for the Global Clean Tech Conference. And we'll have notes and highlights for you after a nap. But
We're a little delusional right now.
I know. I don't think all the spots I'm seeing are from the lights.
Right.
But anyhow, we stayed up so we could bring you Rich Gordon. And so I could quickly tell you, buy these stocks.
Absolutely.
ATVI, FXI, LNY. They're all on sale today, kids.
You had to
The
squeeze
world's
those
not
in,
going
huh?
to end. Yes, I did.
Okay, let's go to Rich Gordon. Rich Gordon, fixed income market strategist of Wachovia, ticker WB, discusses his recent coordinated central bank actions involving trillions of dollars in programs in the US and Europe and the effects this has on the financial sectors. Here it is.
Investors have now had a week to digest the extraordinary coordinated central bank actions in the U.S. and Europe. It appears that the trillions of dollars of programs are beginning to have the desired effect on the financial sectors that are frozen primarily from liquidity issues rather than credit-related concerns. Consider the following points. First, LIBOR rates have finally begun to decrease, which reflects a slow thawing in the interbank lending markets. The central bank actions are primarily geared towards stabilizing the banking sector and include direct capital injections, guarantees for new debt issuance, and government CP purchases. Second, the TED spread is contracting. The spread between 3-month LIBOR and 3-month Treasury bills has always been a good indicator of the health of the banking sector, as well as being a general barometer of risk aversion. The chart shows that in the wake of the failure of Lehman Brothers in mid-September, the TED spread tripled as nervous investors drove bill yields to record lows and banks increased cash balances in order to meet retail withdrawal requests and corporate draws on revolving lines of credit. Over the past week, we've seen the TED spread contract by 175 basis points, which we consider to be a very positive sign. The third thing is that money is flowing into money market funds again. During September, when one of the largest money market funds in the country broke the buck after sizable markdowns on Lehman short-term paper, money market outflows accelerated as the return of par on even very low-risk investments was called into question. We believe that the possibility of retail investors worldwide withdrawing money completely from the financial system in order to preserve whatever wealth they had left convinced central bankers that coordinated intervention on a massive scale was needed. In our opinion, it looks like this fragile confidence among retail investors is slowly being restored, although the pendulum probably won't swing from fear to greed anytime soon. Money funds have seen net inflows of $105 billion since the coordinated central bank intervention was announced over a week ago. It's also important that the yields paid by the highest quality CP issuers have gradually dropped over that same period. Every trader and investor can give examples of large dislocations in the sectors they follow. It's the result of some combination of illiquidity, financial counterparty risk, lack of access to funding, forced deleveraging, and deteriorating credit fundamentals. I believe that this is also roughly the order in which sectors will recover. Those that are almost entirely a function of liquidity and/or financial counterparty risk will recover first, and this recovery already appears to be slowly underway. We can see it in the thawing of the money markets as well as the recent uptick in Treasury yields. The 10-year yield is backed up almost 40 basis points since October 6th. The collapse of several major financial institutions worldwide spurred a powerful flight to quality bid for treasuries that's only now beginning to subside. Also, swap spreads look like they've peaked, as direct government capital injections into major swap counterparties should significantly reduce the perceived risk of entering into swap agreements. As a result of the measures taken by world central banks to support the financial system, the risk of default of any major swap counterparty has been greatly reduced. We can see this in their debt spreads and CDS prices. The spreads of the 5 largest banks has contracted by an average of almost 130 basis points over the past 5 trading days. That's where the good news for the spread sector stops. Almost all of them are being hurt by the factors I already mentioned: lack of access to funding, forced deleveraging, and deteriorating credit fundamentals. As a result, their recent performance has been very poor, making the past 4 weeks the worst period of spread sector performance in history by far. Let's look at the securitized benchmarks first. The charts show that since September 15th, liquid AAA ABS has widened by well over 200 basis points, approximately 6 points of relative underperformance versus swaps. And AAA 10-year CMBS have widened by 300 basis points, roughly 20 points of underperformance versus swaps. The one securitized sector that does appear to have stabilized is the government-backed mortgage sector. We've seen option-adjusted spreads tighten over the past week, although the government's decision to use a combination of asset purchases and direct capital injections into financials rather than just using asset purchases may have diminished some of the potential upside in the mortgage basis. Look for mortgage rates to gradually fall as the measures undertaken by the Fed and Treasury Department slowly filter their way into the mortgage lending markets. The cash credit markets remain nearly crippled after an astonishing loss of absolute and relative value since mid-September. Part of this underperformance is due to a change in the consensus on economic growth to now being almost a unanimous view that the U.S. is currently in a recession. The only point of contention that's left is whether or not it will be moderate or long-lasting and pernicious. But a lot of the destruction of value in the credit sectors has to do with the, quote, leveraging of the credit markets over the past 5 years through basis trades, total return swaps, CDOs and derivative structures, and hedge fund purchases of collateral on margin. That additional leverage is collapsing in a small fraction of the time it was built up over. Even after such a huge adjustment in valuations, these sectors still don't appear to have stabilized and reached a new equilibrium. The corporate credit markets also remain very cheap too and very detached from the equity markets. Equity prices appear to have stabilized since the central bank's rescue plans were announced, which is interesting given the extreme subordinated position of equities in the corporate capital structure. Logically, the normalization should be from the top of the capital structure down and not from the bottom up. But equities enjoy greater liquidity and much broader retail sponsorship. So the fact that they appear to have stabilized first makes a lot of sense, especially given the pecking order of recovery we laid out earlier. Overall, we believe that the massive support from central banks announced recently will significantly reduce the risk of seeing the worst outcomes for world GDP. But it's sobering that stock markets in the U.S. are off almost 40% from their highs last October, and home prices are off 20% from their peak on a national basis. Taken together, it represents a multi-trillion-dollar loss of household wealth and probably ensures that the U.S. will see its worst recession since 1981-82.
Hey, Rich Gordon's everything that's good about Wall Street.
Yeah.
Smart, ethical, well thought out gentleman. And you guys should pay attention to what he said, and you should learn from that. We go to great trouble to do that today. We've been here since 1, and we wanted to make sure that we got it to you this morning so that you can hear what he said while the market's still open.
He's such a capacity in space. It's unbelievable.
He's wonderful. The Dow's collapsing, guys. I bought China Mobile this morning, CHL. Take a look at that.
That's it. We're here every day at Wall Street Media. You can find us directly at wsmco.com. Thanks.